Hi, everyone. This is Jason Bierach of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He has over 20 years experience working in the oil and energy industries. Robert Rapier, thank you for joining me again.
Thanks for having me again, Jason.
Now, Robert, things are getting just absolutely crazy right now in the oil markets in terms of, Wall Street. I think basically a lot of these experts on Wall Street, most of these guys are traders. It seems that they've taken out the ruler, they've looking at the oil chart, and they've just drawn a line, with connecting like the points there on the oil chart. And I mean, just hearing, lower and lower oil prices. And I guess, the trend, the momentum right now is everyone's piling out short. What type of experience do you have dealing with, people who make these predictions?
Yeah, generally it's always the same. I mean, prices go down. Somebody's going to predict they're going to go down another $10. I want to be the first to predict that oil's going to negative $5 a barrel. That's the sort of predictions you see. They drop another $5. Somebody's going to predict could go down to. Last week I was seeing 20, and this week I'm seeing 15 and 10, and they go down a little bit more, and they might go down a little bit more, but there doesn't seem to be a lot of science in it. It's just people guessing about momentum and the direction. And the one thing I can say for sure is this price right now today isn't sustainable in any way, shape, or form. It's irrational. It's emotional. But there is a component of it that is rational. That's we have a very large inventory overhang. And that is keeping pressure on the markets, and you've got Iran potentially about to come back online. And, if this was all happening and oil was, $70, it'd put a little downward pressure down to 60. But, when the bear market's going on and everybody's panicking, it's just pushing it lower and lower, even though we're already at an irrational price. We're going to turn around. I mean, you buy a 5-year contract right now, a contract for delivery in 5 years. I don't see how you can't make money because we're setting up for a big slingshot back in the other direction. We're paying right now for years of $100 oil where everybody could go out and get easy money, and people were forming companies and they're going out and drilling in marginal prospects. And, this is the flip side of that. You had too much capacity built out. And then OPEC decides to compound matters by dumping more oil into an already oversupplied market. And, it's predictable. Every time OPEC meets and when they come out and they don't say, we're going to take action, we take another step down. And OPEC just met again in December. And when they met, we took another step down. We took a step down back in June, I believe it was, when they met. It's happened the last 3 meetings. They've come out of that meeting. We've taken a big step down.
It doesn't seem like there's been a massive amount of meaningful production cuts. Now, exploration budgets have been cut. The CapEx cuts, I think the numbers that came out this week, I think $380 billion with a B of CapEx cuts have already been done. And the amount of money that was supposed to be invested was a little over $700 billion. So we've gotten almost, more than half of the total CapEx that was supposed to be spent on replacing reserves, finding future oil supply, et cetera. That money has been cut. But it seems, a lot of these shale oil producers, they keep on producing more oil. We haven't seen massive, production cuts from shale oil producers, and you brought up OPEC. Why do you think these guys haven't cut production yet when it seems obvious, like, common sense, no-brainer that, they should cut production so the price starts to move higher?
Well, it is falling a little bit. I mean, and it is projected to be down year over year by April, I think about 1 million barrels over the peak last April. But most of these guys are trying to hang in there until OPEC blinks. I mean, everybody is trying to survive, so everybody is hoping they're just a little bit more solvent than the next guy. It's like the guy running from the bear. I don't have to be faster than the bear. I just have to be faster than you. They just need to stay solvent a little bit longer, and, some of their competitors will go offline, and then prices will recover, and they'll be okay. And that's what's going on.
Yeah, I think you nailed it, because when I look at the balance sheets of some of these companies, I was looking at Whiting Petroleum in the last couple of weeks, looking at their financials and their investor presentation, and I think, the shale guys were at a Goldman Sachs, oil conference in Miami last weekend or last week or something. And, a lot of these guys a lot of the CEOs of these companies, shale producers, are saying that they need $50 oil to be cash flow positive. And yet, look at the oil price we're at, and they haven't cut production. But I guess when you have that much debt, I guess you can't cut production that much. And then I looked more to for Whiting Petroleum specifically. You know, they have a lot of debt outstanding. They did an acquisition at a bad time of Kodiak Oil and Gas. And here you have a situation where they're borrowing even more money. You know, they had extra money that they could borrow from their revolving credit facility. If they have a debt problem on their balance sheet, why are they taking on more debt? It's just real, I guess, are they just trying to avoid, buy themselves, another couple months of not going into bankruptcy then?
I think so. I think that's exactly it. And you're right, that Kodiak acquisition came at a very bad time.
Now, in terms of OPEC and Iran, I've seen articles predicting, a potential war between Iraq and Iran. So do you think that's why, Iraq and Iran, Saudi Arabia and Iran, Saudi Arabia and Iran, not Iraq and Iran, that, they're still hesitant to cut any production. Like the budgets the Saudis have, they're cutting back on social spending. They're looking for ways to reduce costs. It just seems, a common sense person would say, I'm selling this product at a massive loss. Yes, I'm making up some of it on volume, but I can't do this that much longer. I shouldn't be giving away oil this cheap below my cost. But yet, you have Iran and these other countries wanting to keep on increasing production. What do you think's in their mindset then, why they would keep on doing this?
Yeah, I think I wrote an article for Forbes this past week, OPEC's $1 trillion miscalculation. And it was very popular with people. Apparently, got 166,000 views. It's had in about a week here. But that, I think, and I lay it out there. I think what happened is Saudi miscalculated on how long it would take to really take a huge bite out of U.S. shale production, and then it would be offline for a while, and they would have market share back, and they would get to benefit from higher margins for a while. That didn't happen. And I think as much as anything, Saudi is trying to save face. I mean, being the biggest oil producer in OPEC and the most influential member of OPEC, and they're out there setting strategy, and it blows up in their face so tremendously. I think they have to stick to course right now. Otherwise, they admit they made a mistake, and people begin to doubt that. I mean, they should be doubting now that Saudi really has a good control over the oil markets. I mean, I can promise you they had no idea that this was going to happen. Oil was still trading at $75 when they embarked on this strategy. And I can see them thinking, okay, the marginal shale barrel is $80 a barrel, and we might drop down to 65, and we're going to take a lot of these guys offline. But once it started to fall and they saw that production was not falling, because it actually continued to go up for another 6 months after they embarked on this strategy, I think they felt like they had no choice but to continue, even though it's inflicting a lot of pain. I read today that 9 out of 13, I think, members of OPEC wanted to make production cuts, but the 4 that didn't were the 4 that have all the spare capacity. So, and that's Saudi Arabia. And so, OPEC generally does what they want. I just think they've made a tremendous mistake. It cost them $500 billion last year. It's going to cost them more than that this year, the way things are going.
Yeah, the U.S. shale oil producers, Robert, seem to just keep getting more and more credit. Just when you think they should go bankrupt, they should cut production, they keep, figuring out ways to raise money or cut costs. And, I guess the CEOs of those companies deserve at least some credit for managing to keep their companies out of bankruptcy for a while and being creative with cutting costs and things like that. But they're kind of just postponing the inevitable, it seems to me. I guess the Saudis, like you said, miscalculated. They didn't expect the Wall Street banks or whoever is funding these shale oil producers. Obviously, it's backed by the Federal Reserve, but they didn't expect these guys to get the credit because they looked, I guess, at the production costs. They don't look at the balance sheet and see that, oh, these guys, can draw their credit facilities for another 6 months or a year, and we have to run the strategy longer than we thought.
Well, the banks can't afford massive bankruptcies in the industry either. So I think the banks can look, too, and say, they're probably thinking Saudi is going to have to blink here at some point. It's funny, if I'm Saudi Arabia, if I'm running OPEC strategy, I can have oil prices back to $60 or $70 next week. I mean, I could literally do that by just cutting production by about 10%. That's about all it would take, about a 10% production cut, and the market would be more than balanced. It's a calculation that I did in my article. I said, if instead they just drop back to the market share they had a few years ago, because they've increased market share over the past few years, and then it started to decline with the shale oil boom, and they're trying to get back to the peak. And if they would just give up a little bit, they could have had their probably $70 oil for several more years. And then the shale boom was going to peter out at some point. And the only reason the only way to rationalize Saudi's decision is if you believe that shale oil production was going to continue to expand for, decades or more than a decade. And I don't believe that's a reasonable expectation. I just think they could have given up market share for a few years and maintained the price. And then as the shale oil production peaked, they'd start to get their market share back.
Yeah, everything has just gotten so out of whack. I mean, I look at supply and demand, and I don't think demand has totally collapsed. Now, obviously, there may be some supply, some oversupply. Whichever numbers you look at, there's a discrepancy. I think it's 1.5 million barrels per day or 2 million, depending upon which people's numbers you look at. But then I look at the costs of the production, the supply side of the equation, and, deep water, whether that's North Sea or Gulf of Mexico, most of those wells are uneconomic. They're very uneconomic. You look at shale oil, a lot of these oil companies are saying, oh, we've cut costs and now we're cash flow positive at 50. We can generate free cash flow at 50. We're nowhere near 50. So that's uneconomic, most of those. You look at oil sands, and most of those wells are uneconomic. I know Suncor was claiming, I think its all-in costs were around 40 something a barrel, but now we're below that too. So I don't know, maybe besides the Saudis being able to pull oil out of the ground very cheaply and a small producer or medium size here or there, it doesn't seem like there's that many people able to make money now. Obviously, the Saudis can make money producing oil, but the thing about these OPEC countries like Venezuela and Saudi Arabia and stuff, they have so much money already committed to their social programs.
Right.
So it's just, I don't know, like you said earlier in the interview at the very beginning, this is unsustainable. This thing has lasted, this correction, a lot longer than I thought any rational person would assume. It's just amazing. But I think a large part, the reason it's lasted is because the shale producers keep, not cutting production, and they keep managing to figure out ways to delay bankruptcy.
Yeah, and I think in 2 or 3 years, a lot of people will be kicking themselves because they will say, well, of course prices were going to rebound. I mean, why on earth weren't we buying oil in the 20s? Of course it was going to rebound.
Now, Robert, you've been around in the oil and energy industry for a while, I think over 2 decades. Is this right now worse than the 1987 crash? Is sentiment that much worse? Because I know we've seen a lot of people lose their jobs in Texas and North Dakota and stuff like that.
It feels worse to me because mainly we've got this huge overhang of inventory. And until that starts to turn, I mean, right now, I don't see a good reason. While I can say the oil producers aren't making money, as long as those inventories are building, that's not going to matter because there's going to be continued pressure on prices until producers, ramp back on production. So right now it feels worse. We'll see how much longer it lasts. I think if it turns soon, I think we'll say it wasn't as bad as that. But right now at this moment in time, it feels like it's worse.
Do you think then like a major bankruptcy of a large oil producer, like maybe Petrobras going bankrupt or a couple large shale oil producers going bankrupt or something like that, do you think that would convince the market then that, a lot of supply is going to come offline and we're going to have a bottom soon? Yeah,
I mean, you can see that right now. You can see the trends. You mentioned demand. Demand hasn't collapsed. In fact, demand is still growing. They said demand in China is slowing down some, but it is still growing. The demand growth is slowing. Last year the IEA reported that demand was growing at 1.5 million barrels a year, still the fastest rate in the last 5 years in response to low prices. And most of the production that's come online over the last 5 years has been U.S. shale oil, and that is now in decline. We're, I think, 500,000 barrels off the peak level of last April-May timeframe, and the EIA is expecting production to continue to decline for several months. The question is, will it decline fast enough, and will demand go up fast enough to cause these inventories to go ahead and peak and start to come down? Until that happens, you can't say that we won't go down lower until that starts to happen.
Yeah, I mean the trend traders, exactly, the trend traders, the momentum traders, these people don't give a shit about fundamentals. They don't care.
Yeah.
You know, the chart says down. The way, you know, trading is taught on Wall Street, there's no emotion. So it's the chart says down, everything, all my trades are down. And that's just how things are right now in the short term. You know, in the long term, though, things are going to have to change. In your 2016 energy predictions, I know you're expecting, I think, oil to get to around $60 a barrel again. That would be a huge move. That would be a very profitable long side trade for people. I actually think, you know, we could get back there too. I put out a report. I think you told me you read it. If this market was rational, if the oil market was rational right now, we would have supply and demand somewhat more balanced, without the Saudis trying to implement their strategy to bankrupt shale and things like that. We would have, you know, a market maybe between $55 and $90 a barrel. But I think we're at a stage here in the oil supply demand with, the lack of the ability of consumer to get a high paying job and discretionary income. The consumer can't really afford $100 barrel higher. You know, we talked earlier in the interview about the bottom, the downside momentum and the price momentum with this emotional, but you know, on the upside we had that too, from 100 up to 147. So we had that in reverse in 2007, I think it was. So I mean, you know, and anything, if the market goes too high or too low, you know, if it goes too high, the consumer can't afford the oil, and if it goes too low, the producer can't make any money.
Right. And I think, from a fundamental perspective, probably oil should be trading at about $60 a barrel from fundamentals. And we will return to that level. And the longer we stay here where we are now, the more we're going to overshoot that mark. And the question is, do we start to recover soon enough to hit that mark by the end of the year? I think it's an aggressive prediction. It's certainly, I don't see any recovery over the next few months. And certainly as long as inventory levels continue to rise, that prediction is way, way out there. When that starts to happen, when the inventory starts to come down, then I think you can say, okay, we've got that in our sights now. We can see that down the road here. As long as this trend continues, it's going to drive oil prices back up. And, you know, on Saudi strategy, you can see it rationally from their perspective. They're saying, look, we're a low-cost producer. In what kind of rational market does the low-cost producer cut production so the high-cost producer can stay in business? And that normally, you know, you'd say, yeah, that may be true, but, you know, there's a price to that strategy. There is a price to be paid for a price war, and they just didn't price the high-cost producers out of the market as quickly as they thought, and so they've paid a really high price.
Yeah, I completely agree. I think they underestimated the ability of, you know, the Wall Street banks or whoever was the creditor of these shale companies to keep giving them more credit. So, you know, even though these shale producers were much higher cost, they kept getting more and more credit to keep themselves afloat, and I don't think the Saudis fully accounted for all that, especially, you know, now where money can almost, with fractional reserve banking and the central bank and the Federal Reserve and the problems with that, you know, they can create credit bubbles and things like that. I think the oil market, you know, if we do have these loan defaults and the banks start to write off bad loans, you know, there's going to be problems in the rest of the economy because the oil market is so large.
Yeah.
Now, the natural gas market, because natural gas is being produced, I guess, in the United States as a byproduct of the shale oil, because they're not really drilling any more gas wells in the United States. It doesn't seem smart to do that. But we're not going to see any type of real recovery then, probably in any long-term recovery in the natural gas price until the shale oil wells come offline. Would that be your guess?
Yes. I think, and that's another prediction that I made for the year. You know, we've had 10 straight years of increasing natural gas production. But I think with the low gas price where it's at right now, and gas producers are not making money right now, and with the associated gas with the shale oil coming down, I think we're going to see that change directions this year. I think we'll see oil production decline for the year, and I think we'll see natural gas production decline for the year. It won't be a big decline. I mean, if you look back in 2015, every single month in 2015 was higher than the year before. So last year was a pretty decent advance despite soft prices. But I think this year, with the oil production starting to go down, I think we finally impact shale gas production. I think overall natural gas production in the U.S. will decline.
Now, I want to ask you how this translates into potential investment. I have a lot of my listeners here looking; they're value investors. They like commodities. They have precious metals exposure, but I've gotten them interested in oil and the energy markets. I was obviously early. I thought the oil price would have bottomed already, but in terms of like the oil market right now, the companies, the producers, do you think this is a stock pickers market? Then, do you think people, if they're going to buy individual stocks, do they need to know accounting and learn how to read a balance sheet and check the debt of the oil producer or the oil service company or the MLP pipeline company? Because basically we've got to a point now, I think, I've seen articles from some Wall Street some people who are normal short sellers. They're telling me, every single MLP company is, I think they called it a Ponzi scheme. But, at this oil price, Robert, it doesn't seem the business model of a lot of oil companies works.
Yeah, I mean, the question, yes, people better pay attention to fundamentals because there's going to be a lot more bankruptcies in this market. And there will be companies that will survive this just fine. I mean, EOG Resources will survive this just fine. They will be standing at the end of this. They may even scoop up some companies during this carnage. They've got a strong balance sheet. You need to look to companies like that with strong balance sheets that won't prosper at, $30 oil, but that will hang in there until, things turn.
Are you surprised that the larger oil-producing companies, the integrateds like ExxonMobil and Chevron, are you surprised they haven't cut dividends yet? Because we've seen even Kinder Morgan cut dividends, and, they were considered one of the safest MLPs out there.
Yes. Well, some of the MLPs are still generating positive, distributable cash flow. I mean, their coverage is they have better than 1.0 coverage. Some of the oil companies, like I've watched ConocoPhillips pretty closely. I own ConocoPhillips from the time I worked there, and there's a lot of speculation that they probably need to cut their dividend, that they don't have the cash flow, will not have the cash flow at $30, $40 oil to cover their dividend.
Do you expect then, like Chevron or ExxonMobil, to come in and I don't know if they have the cash to do this right now, but maybe trade stock since they have stock right now? I know they don't want to give away stock for cheap, but if they can go buy long-term quality oil assets in the ground, good reserves, maybe a little bit of cash flow right now, go and buy. Maybe make a bid on EOG Resources or make a bid on Pioneer or make a bid on some of these other quality American oil producers. Are you surprised then that we haven't seen any of these large takeover attempts yet? I know we've seen one large takeover attempt that was up in Canada, but we haven't really seen many in the United States.
Yes, I'm very surprised. I expected, like right now, if I'm ExxonMobil and I'm sitting on pretty good, some cash in the bank, I'm certainly looking around at some of these companies whose reserves are now trading at ridiculously low levels. I mean, you can go find oil reserves on some of these companies' books cheaper than you can go out and find them in the field. So I am surprised we haven't seen more acquisitions.
Yeah, I think that's the CEOs of the larger companies because, of the smaller shale oil producers. I know Whiting Petroleum was attempting, their board of directors was, I think last year, the year before, was trying to put the company up for sale not too long after the ill-timed Kodiak acquisition. But, they wanted a higher share price to do it. I think now they'd be willing to do it at almost any share price just to avoid bankruptcy.
Yes.
So you think then the in terms of safety right now, there's still some safe MLP plays, and the larger oil and gas companies are relatively safe then?
Yes, I think so. Again, it's there may be some exceptions, but the larger ones are pretty good. Chevron, I think, is in okay shape. ConocoPhillips is in okay shape, but I think they probably would be best to cut their dividend. Although, the CEO said over and over again, protecting the dividend is of utmost importance. But as an investor, I don't want to see them, giving away money when they could use it to hang on and not have to sell assets at distressed prices, because that's how they're going to fund that dividend right now. They're going to have to sell some assets. But across the MLP space, there's a lot of MLPs that are still going to be just fine. There's some that are overly leveraged, and Kinder Morgan, the handwriting was on the wall on that one for a while, and there are some others. Upstream MLPs still. I mean, if you're a gambler, those will recover tremendously if oil prices recover, but they will also go bankrupt, many of them, if we don't get some recovery in the price of oil. Those guys will not be able to hang in there. They're pretty leveraged as a group.
Yeah, I have them in a speculative section in my report. I think, if like Lynn Energy or Brightburn or Memorial Production Partners, these guys had some of the best hedging programs in the business. The problem is, you can't hedge for many, many years out. And so they were only hedged for 2 or 3 years, and the downturn, the oil bear market has lasted, well over a year. So you have the market worried about that with the debt and things like that. So it's kind of a race whether or not, the oil price goes back up, whether or not they can, start paying off their debt consistently with cash flow and things like that. It's very interesting. Unfortunately, I think a lot of companies borrowed a lot of money when the oil price was around $90, $100 a barrel, thinking, the oil price may go a little bit lower, but it's not going to crash. And, now you have a situation where a lot of the CEOs of these oil companies are stuck holding, well, the shareholders are stuck holding the bag, but I mean the CEOs of the oil companies mismanaged and didn't protect their balance sheets enough.
Yep.
Okay, great. Well, Robert, I think this is going to be an interesting year. I agree with you, though. I think, maybe in the short term, the oil price will get worse before it gets better, because right now the traders are in control of the price. But after we start seeing either some bankruptcies or some supply come offline, I think that'll be the sign that the market's going to turn and start going higher and balance out.
Yep, I agree. And if you got some dry powder, it probably wouldn't be a bad idea to start to shift some money into this market. There is some downside risk, but there's no way that over the next 3 years you're not going to make money. I mean, the price of oil must go back up. There's no question. It has to.
Well, there's downside risk, I think, in the regular stock market now. The regular people were saying the regular stock market, was good and safe for years. It was safe, and now it looks like it's about ready to have another large major correction or crash. So if the oil market has already had this crash, you're getting assets for cheap, right?
Exactly.
So,
that's what I tell people. I mean, the rest of the market may be about to have their bear market. The oil markets have had it. I mean, the energy sector has had their bear market.
Yeah, and it's a fool's game, I think, to try to get the exact time on a bear market. So what I do then with my own personal portfolio then is I don't try to buy my positions all at once. So, I have been speculating on some of these oil stocks. You have a company like Seadrill, which it owns some of the best deep water offshore rigs in the world. And I think that stock is below $3 now. And their balance sheet's not totally awful. So you have some interesting ideas there for speculations of companies that, if we get to your oil price prediction of $60, deep waters starts to be economic again, and these companies can make money, you can do pretty good. Obviously it's not a low-risk, long-term investment like an ExxonMobil or something, but, it's an interesting speculation.
Yes, yeah, I agree.
Okay, Robert. Well, thank you for your time, and please tell our listeners where they can find your article for your predictions on 2016, and also the article you wrote about the Saudis and OPEC's miscalculation.
Yeah, so I write for several different places. My predictions can be found at energytrendsinsider.com. I set up my predictions for the year there in the most recent column. I also have those up at Investing Daily, and then I have a regular column at Forbes, regular weekly column, and last week I wrote a column called OPEC's $1 trillion miscalculation. That column was actually a result of an appearance that I made on CNBC Asia's Squawk Box over Christmas, and they asked me about OPEC's strategy, and I said it cost them $500 billion last year, probably cost them another $500 billion this year, and that seemed to generate a lot of interest with them. And they actually titled that video clip, OPEC's giant costly mistake. And I thought, I should follow that up at Forbes with a little bit of math and showing my work. And it worked because it was a very, very popular article.
Great. And, I've been following your work for a decade now. I think since I started learning, I found you from Chris Martinson's website about peak oil and learning about it. And, the thing about peak oil, and the people right now will say, oh, there's no peak oil. Look how cheap the oil price is. This oil price is not sustainable. The oil companies cannot make any money at this oil price. So maybe at, $65, $70, $80 a barrel, there's a lot more oil. At $100 a barrel or higher, there's definitely a lot more oil than at this price. But at the current price, this is definitely not sustainable.
Right. And next time we can talk about why the oil market is not the coal market, because I hear a lot of people say, Well, coal is going away because you got all these other things coming online, and oil is going to also go the same way. Oil is not coal. There's a very, very different situation. There's no substitute for oil.
Exactly, and most of the people that say the oil market are going away are people that own Teslas.
Yeah. Yep.
And the electric car market, I do like hybrid electric vehicles, and Teslas are really cool, but I don't even think the electric car market's 1% of the total global cars that are.
It's about 0.7. I just did a story on that too for Forbes, and actually sales were down last year versus the year before. So my point in writing that article was. The title of that article is "The Fallacy of Peak Oil Demand," and I said this is why oil demand is not going to decline. People think electric cars or biofuels or different things, and I said, I just took them on one at a time, and I showed the electric car market, and I believe electric cars will continue to grow. They just won't grow at a fast enough pace, and they're starting at too low of a level to really have an impact on the global oil market. Despite the rapid growth over the past few years, the oil demand has grown substantially over the past few years. So certainly it's not making a dent yet.
Exactly. And over the long term, if the oil price stays this low for a little while longer, you're going to see demand be stimulated. So you're going to see people want to drive more, and you're going to see people switch to SUVs. And that's just human nature. I mean, when they can save money, or it's going to cost them less money to go on family vacations and drive, or bust out the Suburban or Tahoe that was in the garage, you're going to see more of that. And that's how markets bottom.
Yep.
So the people who are extrapolating this trend, maybe they're right that oil will go to $20 or $15 for a couple weeks or a month or something, but it's not going to stay there. I think I've heard some really stupid Wall Street predictions that it's going to stay. Someone told me oil wouldn't go above 40 for like 5 years or 7 years. I almost started laughing. I forget where I read that recently.
Yeah, that's where you want to say you want to put some money on that. I'll make that bet.
Exactly. Well, thank you again for your time, Robert. I've learned a lot from you and your articles about the oil and energy markets, and Happy New Year.
Same to you.